Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has a PhD in economy. He's a fund manager. He's a follower of the Austrian School of Economics. He's written many articles for the Mises Institute. He's a professor, and he's also written 2 books. His most recent one is Escape from the Central Bank Trap. So hopefully he will give us some hints about how we can escape. And The Energy World is Flat. Daniel LaCalle, thank you for joining me again.
Thank you so much, Jason. Always a pleasure.
Now, Daniel, I want to ask you about the Fed rate hikes. So if the Fed keeps hiking rates, I guess they're planning maybe another 3 rate hikes by the end of 2018. Do you think eventually this is going to start breaking something in the real economy or asset markets or credit markets?
I definitely think that it'll start the end of the bubble in some of the asset classes that have been inflating aggressively throughout this last 8 years. If you think about it, the first part that is at risk is this monster bubble in negative yielding bonds, both in Japan and the European Union. It's about $7.5 trillion. It's not a small figure. And obviously the high yield market, those very challenged companies that were issuing at multi-decade low yields are also going to find themselves in trouble. But everywhere else, I think it's a very healthy, very needed, probably a little bit too late, in some cases, but it's a very important path of rate hikes, because for the first time in, I would say, 9 years, we have a president of the Federal Reserve and a Federal Reserve composition that are not scared about short-term volatility of markets and that are willing to do the right thing. And I think that the right thing right now is trying to avoid that what is already very elevated, very aggressive asset prices becomes a systemic risk.
And the central banks have fueled those asset prices. I don't know if you saw this, but Dr. Harold Malmgren put on his Twitter a couple weeks ago that this chart showing that 45% of global GDP is on central bank balance sheets. So the central banks, Daniel, are claiming, especially the Federal Reserve, claiming that they can meaningfully reduce their balance sheet. I just don't see where they can meaningfully reduce their balance sheet without breaking something in the economy, asset markets, etc.
I completely agree. We are hearing constantly this concept of normalization, and I call it the no normalization period, because everybody's talking about the Federal Reserve bringing down its balance sheet. The balance sheet is at 4.4 trillion. It's been marginally reduced in the last months, after more than a year in which it was supposed to be reducing it meaningfully. If you think about it, it's not just that central banks own about 45% of global GDP, 45% of global GDP is the size of the balance sheet of the main central banks. The most worrying thing is that in a period like the one that we're living right now, where there's no crisis, there's no recession, there's no systemic risk, banks are doing fine. The main central banks are increasing the balance sheet by about $200 billion a month. That is insane. And I think that what we are seeing is an environment in which it's very easy to get into these aggressive, wrongly called expansionary monetary policies, but the reality is that it's very difficult to get out of them, and they cannot reduce the balance sheet meaningfully, as you very well say, without breaking something in the process, because the economy is very interlinked, and it's not just bonds or equities or a few of the stock markets. No, this is about a very intertwined economy in which an abrupt change in asset prices can really derail other parts of the economy.
Well, maybe things are not as good as they appear beneath the surface. And I mean, we are seeing signals that things are starting to break. We've had volatility in stocks. The VIX now is back at 22 again after that large spike last month. and the LIBOR rate, and you could speak about the London interbank operating rate about that more. Why do you think this LIBOR spread is so much larger than regular interest rates?
Well, it's logical. Banks know that their balance sheet is challenged, and that although core capital has been improving and banks are better than they were in 2008, a lot of that improvement comes from this aggressive quantitative easing and this aggressive asset bubble that we have seen. And therefore, it is normal that as soon as the level of risk increases, there's more volatility in markets, that banks become more aware about lending to each other.
Do you think then also, you mentioned the amount of QE that's still going on, around 200 billion per month. Do you think a lot of that is because the ECB knows that there's a European banking crisis and the LIBOR rate is signaling that that's a problem, and that they really don't want to admit that publicly, that a lot of these European banks are still in trouble?
I think it's part of the problem. The ECB knows that after 8 years, European banks have been unable to tackle the problem of non-performing loans. Non-performing loans continue to be more than €1 trillion in the European system. The core capital of banks in Europe has improved, but it's still very, very poor. And more importantly, if you disaggregate that core capital, a lot of it is these bonds that have a certain component, a hybrid component between equity and bonds that are super dangerous, called COCOs. And I think that another problem from the perspective of the ECB is this very dangerous link between government debt, sovereign debt, and European banks. European banks continue to hold a very, very large proportion of sovereign debt, and obviously any abrupt increase in government bond yields rapidly decreases the level of sustainability and the level of liquidity and solvency in some cases of European banks. The European banking system is extremely fragile. Net income margin is very, very, very poor. Return on tangible equity is way below cost of capital. And that's normal, obviously, because interest rates are at zero, inflation is very low, and there are many challenges in the European Union. But the European Central Bank knows that it needs to continue to pump money into the system in order to avoid more abrupt episodes, although it hasn't been able to stop them in some cases, as we saw with the Portuguese banks, with the Italian banks, and with one of the Spanish ones.
Yeah, I think that's what the ECB has been doing. I think they've been doing basically a covert bailout of a lot of the European banking system for a while. So they've been buying up some European corporate debt. Now I think European junk bond debt has a lower yield than US Treasuries, which is really mind-boggling. I never thought I would see anything like that in my lifetime.
It is crazy. It is completely crazy. If you look at the yield of high yield debt in the European Union, it is between 50 to 70% lower today than sovereign bond yields were literally just 4 years ago. So when you go country by country and you think, what is the composition of that we call high yield, which is a very diplomatic name, huh? You see companies that are literally zombie companies. You're not talking about companies sort of improving their balance sheet, increasing their cash flow, or returning to high growth. No, you're talking of companies that are the vast majority of them literally generating cash flow to pay a little bit of interest and getting into and issuing debt to pay interest.
You also, I think it was on the Mises Institute, you wrote a recent article about this, and you said the Bank of International Settlements did a study in the last year or so, and they said about 20% of all these corporations are already insolvent and can barely even pay their interest payments.
Exactly. That's called zombie companies. No? Zombie companies are those who are unable to cover their interest expense with operating cash flow. And obviously, interest expense at current interest rates, not at normalized real interest rates, but at the massively compressed interest rates that we're living right now. So that is very dangerous, because zombification of the economy, let's say from the policymaker's perspective, zombification has a positive, is that you don't see a domino of bankruptcies. Obviously, unemployment is sort of kept contained. That's fine. The problem with zombie companies is that they take a tremendous amount of capital out of the system, and at the same time, they don't generate further growth, further investment, higher employment. You're basically just keeping them alive for no reason, hence the term zombie companies. The fact that the number of firms in this category has risen so dramatically in the last years shows the point that you were making before, is that the recovery is a lot more fragile than what many are trying to sell.
And us Austrian school economists would call, the capital that these zombie companies are absorbing misallocations of capital. And so, they're hurting the real economy in the long term, because that capital could have been used a lot more prudently or not used at all.
Yeah, absolutely. This is another problem of the diagnosis of the problems of the Eurozone that the European Central Bank, that the governments do themselves, not just in the Eurozone, but in general in most developed economies, is that governments always think that it's a problem of aggregate demand instead of excess supply. And as you very well say, the zombification of the economy and the permanent objective to keep GDP at a certain level through government spending, through unproductive spending in general, through any kind of debt, what it does is does not make a healthier economy. It definitely doesn't help the economy become more dynamic, but you end up in this disinflationary period in which debt goes through the roof. There is a little bit of growth. Of course there's growth. If you pump $20 trillion into the economy, you will get some growth. The question is not that you get some growth. The problem is that potential growth and productivity suffer in the process.
I agree with that. So let's transition to the US dollar. So in the past, when the Federal Reserve hiked interest rates, normally that would strengthen the dollar. That was a pretty positive correlation for a long time in the past. For over a year now, we've seen rate hikes by the Fed, and the dollar has basically started a bear market. So why do you think that correlation has broken down?
I think we've seen it a few times before. And at least I remember the 95-97 period and the 2004-2007 period in which it was similar. And I think that what tends to happen in those periods is that the market makes this completely, I would say, to a certain point incoherent, and definitely long-term incoherent view that the rate hikes are not going to affect the inflationary pressures that are coming from the carry trade that has been generated in the past. If I can explain myself, in 95-97, what you had was an environment in which the dollar weakened while interest rates were rising, because most market participants believed that the hikes would not stop or would not put an end to the bull market of emerging Asian economies, for example, which continued to receive extraordinary amounts of cheap dollars to finance their very fragile and obviously flawed growth at the time. And what happens is that this trend can continue for a while. So there's a period, so like we are seeing right now, people continue to believe that you're going to see much stronger growth in emerging economies, much stronger growth in commodity-driven economies, and therefore they don't pay attention to the underlying trends. And then there's a concept that I explain in Escape from the Central Bank Trap, which is the sudden stop. And suddenly, and it happens suddenly, and when I talk suddenly, I'm talking days, that the market participants suddenly get extremely scared because the data that has been ignored for so many months of disinflationary trends, of weakening growth, of worsening of the fundamentals of the emerging markets and carry trade economies, suddenly market participants become aware of that situation as very, very real, and then they come back and then they bring quickly their dollars back to the United States and to treasuries. And that happens very, very quickly. And if emerging market economies are not prepared for that, it can cause very, very big ripple waves into the world economy.
So one of the theories I've heard from a longtime money manager, he was on Real Vision TV in the last week or two talking about this, was that, after the 2008 financial crisis, a lot of money, a lot of flow of funds started flowing into the United States, into assets, buying up real estate, stocks, bonds, etc. in the United States. But this guy's thesis now is that despite these rate hikes, that funds are starting to flow out of the U.S. So do you agree with that, or do you think it's flawed?
Well, it is. I mean, he is right about what is happening now. What I think we probably or may disagree, or I didn't hear definitely all of his argument, is whether that trend lasts. And I tell you why. It is virtually impossible for those money managers that are taking money out of the United States and looking for growth opportunities in emerging markets in Europe itself. It is impossible to ignore the facts. You can ignore the facts for a while, like they're doing right now. We're seeing very, very evident signs of slowdown in Europe, but fund flows continue to come to Europe. Like it's the the next growth opportunity. Same with emerging markets. With commodity-driven economies, you're seeing that metals are falling in price in the markets. You're seeing commodities in general performing poorly, and still, there's still this belief that the carry trade is still worth a try, because. And it is true, those assets in the United States are expensive. Now, the problem is, and that's why the sudden stop occurs, that the only thing that makes the assets that are receiving the funds flows right now relatively cheap compared to the United States is the fact that A, the 10-year Treasury remains below 3%, and B, and more importantly, that there is a continuation of the belief that there will be more inflation and more growth in those other countries than in the United States. When market participants find out, and they do, that those three elements, i.e. the 10-year Treasury, inflation and growth expectations, are actually not supporting the carry trade, money comes back very, very, very quickly to the United States.
Yeah, that fund manager, he's bullish gold, Chinese, I think, growth stocks, and also maybe emerging markets and commodities. I think those were the groups that he's in. I don't know if I agree with everything that he's bullish on, but I think, it's smart to at least have a gold position. So let's transition to China now. I know you've been, our last interview that we did over the summer in 2017, you put out a very good piece for the Mises Institute about the Chinese credit bubble. We've started to see more stories come out about cracks in the Chinese credit bubble. They've been from HNA and Anbang. So what's your view on what the Chinese are doing with HNA and Anbang? Do you think they're going to be doing this devaluation that you've been predicting in the near future, or do you think they're going to try to figure out a way to delay this as long as possible?
The Chinese government needs to try to delay as much as possible a devaluation, because part of the strategy to strengthen the economy requires a strong yuan. However, the prospect of a trade war, which is extremely disinflationary, and that's where probably I disagree with with the person that you interviewed, the other fund manager. The prospect of a trade war, the prospect of a worsening of the banking situation within China that the PBOC itself is acknowledging, and I think that is trying to tackle by putting brakes on credit growth, is very unlikely to help the government delay the inevitable, which is a large devaluation. And I think that it's becoming more and more evident. No. So the problem for the Chinese economy is that if we have a global slowdown in trade due to, I don't know, trade wars, you name it, tariffs, whatever. If you have a global slowdown in trade, GDP growth is going to continue to suffer from the part of the external sector. Exports will come down. So the most likely scenario is that in order to keep the let's say official target of 6.5% growth, which they will try to achieve at any cost, they will increase dramatically debt. Now, coming back to the banks, the government has been and continues to quietly but very evidently inject tens of billions of dollars into the banks in order to cover the equity and the solvency requirements. So what right now seems like a piece of news flow that is not necessarily all over the media ends up being all over the media when the risk of a devaluation is more evident. And I think that China, in that sense, is built on a very weak foundation because of the extremely aggressive level of debt growth. Just in January, China increased debt by almost 350 billion. It's unheard of.
Yes, and in the last 10 years, they've created the largest and fastest credit bubble, I think, in human history. And
Absolutely.
And this One Belt, One Road project, Daniel, it kind of reminds me, I don't think China really cares if it's really that economic for them. I think it's more of an FDR, New Deal, make work project where they're really worried about unemployment rates and men having jobs in my age demographic or younger. So they want to make sure that those men have jobs, have food on the table, money in their pocket, so there's no political revolution.
Very true. Very true. It's Japan 1989. No, it's build stuff. It's the perennial Keynesian view that you need to build things to keep unemployment low, whether those things are going to generate a real economic return or not. But the problem right now is that this is not something that comes after a period of great expansion, tremendous strength in the economy. It comes after a very unsuccessful, and I would like to underline that, a tremendously unsuccessful stimulus in 2008. The $156 billion stimulus that China undertook generated the roots of the problem that we're living right now. Massive overcapacity, huge debt, very, very poor productivity. Remember that China massively underestimates or definitely publishes a very, let's say, surprisingly low inflation, and therefore a completely misinformed or unrealistic productivity. So my concern here is that this new Silk Road is just the same thing over again, but with the added problem that it's not an economy that had the luxury like the Chinese economy did in 2008 of being extremely underlevered and with a high level of savings.
Yeah, I agree. And I think the Chinese government is willing to sacrifice a lot of their trade surplus, that hoard. I think it's around $3 trillion. They're willing to sacrifice a large portion of that just to prevent a political revolution and, unrest from men in my age demographic not having jobs. And nice. And I think a lot of people, especially in the alternative media and the gold community, don't understand that. Because, if you read some of the articles, you see China's about to launch the petro yuan contract. The dollar is going to die. Chinese economy is in such great shape. And, I read your articles. I read a lot of articles about China, and I don't think China's in good shape, and I don't think China wants a gold-backed currency.
No, and more importantly, it's a subterfuge. This whole thing about the China go back petro yuan is fundamentally impossible. It is impossible. China's gold reserves are a tiny fraction of the money supply. Means absolutely nothing. Tiny, irrelevant. If this is the issue. The people in the gold community, the people that are talking about China as the new strong currency, some sort of like currency that is more close to sound money than what other fiat currencies are simply not looking at the data. The Chinese monetary policy is an absolute train wreck. It's a double-digit money supply growth, money printing machine that has absolutely nothing to do with sound money. And the idea that a currency and a country that has capital controls is going to be a world reserve currency is impossible. You cannot have capital controls and be the world's reserve currency. You cannot overtake the petrodollar with the petro yuan that trades 4 hours a day. It's a joke.
I completely agree.
I think that sorry, but I find it so frustrating that anybody in their right mind would think of this as a serious alternative when everything that we criticize about the Federal Reserve correctly, or about the ECB, or about the Bank of England, is done, multiplied by 5 by the People's Bank of China.
Exactly. And the head of the People's Bank of China, in just the last 6 months, he was talking about a Minsky moment. So yeah. And yet there's people in the gold community talking about China's going to have a gold-backed currency in the near future. So it just doesn't make a lot of sense.
But this is like Maduro in Venezuela with the petro. Make the numbers. Look at the entire gold reserves of China. Look at money supply, M2 and M2 growth in China. Look at the assets of the banking system, the size of the assets of the banking system, and tell me how on earth are you going to make those elements fit together to think that the yuan is backed by gold.
And a lot of Chinese companies, Daniel, also want to borrow in U.S. debt. I think there's an explosion of $1.7 trillion from Chinese state-owned enterprises in U.S. dollar debt-denominated borrowing.
Absolutely, completely, and those are the state-owned companies. Everybody has been telling me the last since the elections that the Chinese were going to dump their treasuries, and I look at the data. I don't care about anything else. I look at data. Before the elections, they had $1 trillion of U.S. debt. Now they have 1.168. That's an increase of 168 billion. They're buying, not selling.
So do as I say, not as I do.
That's a good one, yes.
So I think one of the main reasons that they have been buying, Daniel, is because they were worried that President Trump, because remember, during the campaign, he was talking about tariffs. He was talking about starting a trade war. And now he's starting to implement that. So not only did he do aluminum and steel, which wasn't, for most other countries, that wasn't a big deal. For China, it is, since they basically flood the global markets with artificially cheap aluminum and steel just to keep people employed. But now he's really ramping up the tariffs. I think he's going after he's trying to protect U.S. technology companies. So China just announced retaliatory tariffs. What do you think then? You think we're going to see a game of back and forth like this for a while then?
I do because if you think about this, both from the U.S. side and from the Chinese side, they both have a lot to lose in a trade war. I personally believe that China has a lot more to lose in a trade war, because without the trade surplus, China does not grow 6%, 6.5%, 5%, or 4%. It actually goes into recession. No? So we have to be very aware of the fact that the biggest problem for China is that it needs to continue to grow way beyond what it should. And for that, it needs to sell its goods and services to the United States. It can try to sell them in Europe, but it's an aging population with a high level of unemployment and tremendous taxes. You want to sell that in the European Union? I'm sorry, not going to happen. So you need the United States. It's your market. So China has a lot more to lose from that perspective, whilst we have already seen, and the data is there, that this whole concept that they were going to be owning the will of the United States government because of the ownership of treasuries is completely false. They have continued to buy. So I think that, and of course, the United States has a lot to lose in a trade war. It has a lot to lose in terms of growth of consumption, in terms of employment. There are many things to lose. But I think let's start from what I think and then what I don't think. I think that this is a showdown, and that the Chinese will have to come to the table with improvements to the trade barriers that China imposes to the United States. There is a 60-page document from the government of the United States showing the monster amount of trade barriers that the Chinese directly and indirectly implement for U.S. companies. There's a huge problem with intellectual property, and hence the tariffs on technology. There is a huge problem with dumping of state-owned enterprises in steel, in solar panels, in aluminum, all these things. So all these things. So and in the past, all other U.S. administration have dealt with this issue by playing nice. This new administration not willing to do that. Is it a good strategy? I don't know. But what I do think is that it is going to be extremely difficult to take the trade war to a real trade war. Now we're on threat territory. We're on a moment in which everybody's threatening. But I think it's going to be extremely difficult to bring it to a real trade war, fundamentally because both sides, China and the United States, have a lot to lose. And I think that if China has as a core of its strategy jobs and keeping the peace within the country, it cannot start a trade war with the United States, knowing, as they do, the Chinese know it, that the trade barriers and the interventionist measures are very, very real.
We'll be right back with Daniel LaCalle after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. I study history a lot. That was originally my background. And the more I see what President Trump is doing, the more I think he looks like President Herbert Hoover, who was one of the key drivers for the Smoot-Hawley Tariff Act. And the Smoot-Hawley Tariff Act, created retaliatory tariffs. So, I really hope I'm wrong about this, but it looks like we're headed down that path, which was very dangerous because not only did that hurt the U.S. economy, it hurt the U.S. consumer. They didn't allow wages and prices to fall back then. Farmers were paid not to grow food, and people who weren't in soup kitchen lines starved. But, the other economies who had tariffs put on them, that destroyed their economy too, and then that eventually led to war.
Yeah, I think that the difference right now, many differences. I agree with some of the similarities, but let's start with the differences. First, the world is so indebted, it's impossible to go to war. Can't pay for it. Yeah? The second problem is that the world is so interconnected, whether governments like it or not, that it is literally impossible to be as aggressively protectionist and as closed economy policy driven as Hoover was. Additionally, at the time, governments did not have, coming back to the debt, did not have such massive requirements of refinancing. And that's a very important factor because you will need international investors. And so it's a much more complicated, let's say, environment. But I don't disagree with the fact that you start the threats of a trade war, and it might look like a showdown, and it might look like something that is simply there to force a negotiation, but politicians don't necessarily act logically, and it can end in a trade war.
And history is quite clear about trade wars. So even if this is a negotiating tactic, like art of the deal type of tactic by President Trump, this could backfire and lead to actual real much larger tariffs. And, that's going to hurt pretty much everyone. Pretty much no one wins in a trade war.
No one wins in a trade war. No one wins in a trade war. I'm hearing from brokers, from investors, some really completely wrong estimates saying, the trade war is going to hurt this country, but it's not going to hurt the other. No. Trade wars absolutely devastating for global growth, for global employment, for consumers, for employees. All of the things that you try to protect are massively offset on the negative side by the negative impact on global trade, global growth, global financial markets as well. And the financial markets are very important.
So let's transition to the oil market now. We have a WTI crude price of around $65 a barrel. We have a Brent crude price almost at $70 a barrel today on the day that we're speaking on Friday, March 23rd. So what's your view then on this oil market? We've had the cuts from the Saudis. Do you think they're going to stick to the cuts? And then also we're at a price now, and you can correct me if I'm wrong about this, where the deep water offshore oil drilling and also production that has been capped, that was not economic for the last, 4 or 5 years, that's going to start becoming economic in the near future, right?
Oh, no. Right now, every single drilling technology is economical right now. Economical as in generating 10% return on invested capital. All of them, because service costs have come down so much. And the service industry has become so much more efficient that all of the technologies, deep water, ultra deep water, oil sands, you name it, the most far away drilling in the worst part of the North Sea currently at these prices is economical. So that on one side that shows that there's plenty of supply opportunities. Now, OPEC really needs to wake up. If they keep this massive cut, and while the economy starts to slow down globally, while there's a risk of trade wars, and while the markets start to dive down, they keep putting prices up and up and up and up by limiting supply. Then what they see is what we saw in 2008, in 2013, in 2015. What they see is that then oil prices collapse because they choke marginal demand expectations. So I think that their strategy is completely misguided. First, by keeping prices elevated, they have bailed out all of the let's say competition. All of the competition right now has been bailed out. the sector has never been in a better shape in terms of balance sheet, in terms of efficiency, in terms of costs. So there you go. That was a fantastic Christmas present from OPEC to the rest of the industry. But the second one is, if you continue to increase artificially the price by limiting supply, in an environment in which the global economy starts to show signals of not recession, but certainly change of cycle, the next move is not a little bit lower to, let's say, 60 or 55. It's to 25. So I just simply, I think, it's incredible.
And that would be, and if we do get to that 25 mark you're predicting, that would be bankruptcies for possibly even governments. I mean, Venezuela is bankrupt now, and Venezuela was in a lot of trouble even when the oil price was higher, but some of these other oil-producing nations, they rely on the oil revenue so much that that low oil price, that would be disastrous.
It would be disastrous. So if I was in OPEC today, I would say, look, oil prices are 65 WTI, $70 Brent. So what am I interested? I'm interested in three things. Market share, I'm interested in oil revenues, and I'm interested in long-term sustainability of demand. Okay? Those three things. So if I'm interested in those three things as an oil producer, I might as well start curbing this completely misguided production cut quickly. So because what we would see is that because inventories are coming down, because things are improving in the oil market, what they would see is that they will get more oil revenues. They would sell more, they would increase market share, and the price would be enough for the consumer nations not to enter into this negative spiral created by weakening asset prices, challenges to the global growth, and high commodity.
In my opinion, I think the global economy needs kind of a Goldilocks oil price, where if a Goldilocks oil price, where if the oil price gets too high, the consumer can't afford it, especially the marginal consumer who doesn't have discretionary income. They start cutting back on driving, they carpool, take public transportation, etc. But it basically acts as an interest rate increase. So at oil at $80, $90, $100 a barrel, that starts to act as an interest rate increase, like the Federal Reserve raising interest rates. But if the oil price goes too low, then countries and bankrupt countries producing oil, like national oil companies and the other oil producers, they start to go bankrupt. So it kind of needs that sweet spot, but it's a commodity market, it's volatile. So I don't think we're going to stay flat for a while.
No, I agree. The oil market always overshoots on the upside and on the downside. When it goes up, everybody says that it's going to go to 100. When it goes down, everybody says that it's going to go to 25. It never stays either side for a very, very long time. What I do think is exactly what you just said, is that OPEC countries and producers in general would definitely need to wise up to the fact that they need to have bear in mind the objectives that OPEC has in their mission, which is an oil price that is good for producers and for consumers, and that is starting to become not the situation right now. More importantly, and this is the key point, it is ridiculous to have Saudi Arabia producing 7 million barrels a day at $70 a barrel Brent, when it can produce 10 million barrels a day at 60. Do the maths. The revenues are higher.
So I think, this production cut, it's allowed U.S. shale oil producers to gain an enormous amount of market share. What's your view, though, on the overall U.S. shale boom? Do you think that it's a credit bubble, too, that there's been a huge amount of misallocation of capital and eventually this thing will bust?
There was. But the good thing about the shale industry, the oil industry in general, is that it's always been like that. All of the big technology and all of the big changes in the oil industry have come from periods of boom that went to bust. And you have this cycle all the time in which small companies, use a lot of debt, increase their production, grow their prospects, etc., then the things start to get a little bit nasty. Then the big oil companies absorb them, and it's almost like an organic process. It's always been that way. It happened, but the reality is that shale companies have become a lot stronger. And that when we were talking in 2015 to 2014 about massive bankruptcies happening all over the place, well, they've done capital increases, they've done asset sales, they've done many, many things. And the health of the shale industry is currently much, much, much stronger. But again, I come back to the point. The oil industry is always like this. It is small companies that create new technologies, that develop new areas. Those are the ones that explore. Those are the ones those are the ones that get the big oil finds, and then they get absorbed by the larger companies, and it becomes a much more stable environment. But in general, I'm not worried about the health of the oil sector. At the peak of the debt process of the shale industry, it was less than 6% of the overall credit market.
So do you think then it's sustainable for the U.S. to some estimates have the U.S. at the top oil producer now in the world. Obviously, if the Saudis hadn't cut production, then that probably wouldn't be true. But do you think it's sustainable? Because a lot of these shale oil wells, whether it's the Bakken, the Eagle Ford, these wells have petered out pretty quickly. There's not a lot of good production growth there. The Permian is the real monster right now, but do you think it's sustainable for the Permian to continue production growth at these rates or continue to grow it then for another 10 or 20 years?
It is. If you look at the productivity per well, it has been one of the big surprises. Also, I think shale, you see, the problem with all of us that have studied oil from a geology perspective using traditional metrics is that shale is not the same as an oil field that has, a curve of growth, stabilization, and decline. The tail end of the production process of a field, of a well, not of a field, sorry, can take ages, no? And so I'm not worried about production growth. I'm not worried at all about production growth. I'm worried about the fact that the way that we're looking at the supply and demand scenario right now is based on a manipulation of supply. I would like to see what kind of growth of production the United States would achieve in a not intervened environment, i.e. with OPEC producing whatever it needs, 35 million barrels a day or whatever is needed.
So do you think then in the near future, in the next couple years, if the oil price stays at these levels, that there's going to be a flood of supply that's going to hit the market and we are going to have that bust, that's a high probability event then?
I would say that the probability right now is not high because the price is not that aggressive. Think about this. We're talking $65, $60, $70 now. Remember that OPEC started their meetings when oil prices fell to 75, saying that it couldn't fall any further than 75. So we're far away still from that. No, it's come back, but it's still far away from where it went. My point is that oil prices will collapse when the market starts seeing the signals of demand weakening, particularly marginal demand weakening, because of a recessionary period. I think we're far from there, but it's not a small risk. It was a much smaller risk a year and a half ago, and it's a much larger risk right now.
So I have a couple more questions in the remaining part of this interview. Your most recent book is Escape from the Central Bank Trap. Are some of these escape hatches, are they precious metals? Are they maybe a few cryptocurrencies like Bitcoin or some of these others? And I mean, we've talked about this earlier in the interview too. There's really not a lot of undervalued assets. So do you think cash is important for people out there who are worried what they're seeing in the news and what the central banks are doing?
Yes, I think that we need to start thinking about, as you very well said, about silver, gold, obviously. We need to think about cash as a very important factor, and we need to think of equivalents to cash. Equivalents to cash are, for example, those extremely boring and completely, I would say, dinosaur-like equities that paid a decent yield, but nobody wanted to buy because they had no growth. Those dinosaur multi-billion companies. We need to start thinking about investment grade, low yield bonds of those very, very boring defensive companies. So there are investments out there. If you look at the recent slump in the market and you forget about Facebook, Amazon, Netflix, Google, the very, very, very expensive technology companies, for example, in the S&P 500, you start to see valuations that are, within the 10-year range. So there are companies, there are stocks that you can buy, but I think that you would have to have a combination of cash, of gold, and of very, 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 let's say, the anti-recession stocks, those that people have hated for so long, like those companies that basically sell very, very reasonably priced goods and don't have a lot of growth, but they don't have a lot of debt.
Those types of companies, you can find them, but in general, they're pretty hard to find because, we have companies like Campbell Soup, I think, trading at like 25 times earnings, and people are desperate for that 3% dividend yield. At least it was 3% the last time I looked at it.
Yeah, but think about it. Yeah, Campbell Soup. Yeah, exactly. It's not a cheap stock yet, no. But at the same time, it is a stock in which, if you enter into a recession, the estimates of consumption of its products are probably too weak, no, or too conservative. Let's see. Obviously there are numerous, but again, I think that the combination is investment grade bonds in that sort of boring part of the capitalization, and gold, and obviously a little bit of cash and a little bit of those dinosaur equities. No, think about it. Look at how atrociously the multi-mega cap oil companies have performed, despite the fact that oil prices are going up. For example, there's a value opportunity for me.
Yeah, there are some good oil and energy opportunities out there. Uranium is another one too, if you're patient, because I think the uranium miners are losing about $40 a pound, so it's obviously not sustainable in the long term.
Yeah.
But I want to get your views on cryptocurrencies real quick. So Hayek talked about denationalization of money. The cryptocurrencies, they were a huge speculative bubble the last 18 months or so. We've had a big bust now. So I'm a contrarian, and I like to buy things that have crashed. Now, obviously, don't buy everything, but they're very interesting after they've already had a big crash.
Yeah.
What are your views on cryptocurrencies in general, and how that would, fit in with Austrian School Economics?
Yeah, I think that two ways of looking at cryptocurrencies. One, from the perspective of alternatives to fiat currencies. From that perspective, cryptocurrencies continue to rise. We have, I think it's 26 million people in the United States alone using cryptocurrencies. I think that in itself is a success, and it continues to grow. So from the perspective of utilization as currencies, that is, I believe, unstoppable, and more unstoppable as we get to realize, as we were talking at the beginning of the interview, that central banks will be virtually unable to get out of these expansionary policies as some investors expect, so reducing the balance sheet and increasing rates dramatically. But the other point is price, no, of some of those cryptocurrencies. I agree with you. I think that, you like to look at, I hate it when suddenly you took a taxi down the street and the driver would ask you about Bitcoin, no? Because that means bubble here, no? Or at least a very elevated, not informed type of interest. But I think that as the situation gets more challenging and governments become, we start to see these devaluation risks that we were mentioning before in some of the emerging economies. What has driven the prices down of cryptocurrencies, which is repression, which is legal and governmental and regulatory repression, and fear of confiscation or literally prohibition, is going to be offset by the fact that people will look for alternatives to fiat currencies.
Yeah, in that respect, I really applaud everything that's going on. I was not an investor. I was not around during the technology bubble, so I know you were. So what's going on with these initial coin offerings, all this innovation with all these different types of altcoins, does that remind you a lot of what happened during the tech bubble?
Oh, completely. I remember when I heard from brokers, "Oh, Daniel, this stock is super cheap. When in 10 years' time everybody pays $2 per email, this company is going to make billions in revenues." Obviously, neither you or I, and we're talking to almost 2 decades after, are paying $2 per email. I think that this is very much the same. These exaggerated expectations, but the good thing about bubbles is that they create what I call the broadband. No, the bubbles are not a problem. It brings a tremendous amount of investment that will stay there afterwards if bubbles burst. And that's the reason why today we don't pay $2 per email, because so many people invested so much into technology that thinking that it would be monstrously profitable, and it yielded decent but not extremely high returns. And I think that this is the same. No? We will see that the implementation of cryptocurrencies is going to be almost inevitable because of the monetary situation of the world, and we will all benefit from the fact that some people, were able to go to the market and do an ICO with tremendous support.
And I think, this is also what Joseph Schumpeter talked about with creative destruction playing out. So we don't know. So some of these older companies, whether it's a Western Union or a MoneyGram, some of them may go bankrupt because they didn't adapt to using the blockchain technology to save themselves money, and they're competing against cryptocurrencies that don't have to make a profit. Or the banks are going to take the blockchain technology, and have you seen the Zelle system? The banks now have with your smartphone the Zelle payment system. If you are a customer of a large bank in the US, you can send a payment back and forth, I think, almost instantaneously, basically for free now. Absolutely. And I think that's using blockchain, whereas, in the past that would have cost you a lot more money to send a payment back and forth with a wire transfer and a lot of time. Absolutely.
So think about it from that perspective. Implementation, to me, is unstoppable. Price, that's a different thing. Price can be volatile and will continue to be volatile, because the more likely that implementation becomes widely accepted, governments will become more aggressive, obviously.
Okay, so last question, since I know you live in London, which is, one of the financial capitals of the world, what's your view on Brexit now? Do you think Brexit's basically, it's been a couple years since the Brexit vote occurred, is the Brexit basically dead, or are the bureaucrats in London, these globalists, the bureaucrats in Brussels, they're just bogging it down with lawsuits and delays and red tape, trying to delay this thing, years more so they can get another vote and then turn the vote back over?
If you look at the agreement that was reached this week, that is precisely it. It basically is a watered down, extremely disappointing type of agreement if you believe in sovereignty. So I think that is there are tremendous pressures from all types of pressure groups, not just bureaucrats, but also multinationals, etc., to try to water it down to the maximum level and to try to make it basically happen but not happen, if you know what I mean, no? So that's where we're at right now. But I think that as reality kicks in, first, what are we seeing? Brexit has not meant the disaster of the UK economy that so many predicted. Unemployment is at levels not seen since 1975. The economy is growing. It might not be growing as much as it did, but it's growing fine. No? And I think that is okay. And on the other side, the challenges of the European Union become more and more evident all the time. And so I'm not an advocate of Brexit. I just think that people voted for it, and that therefore what you cannot do is the government is to try to circumvent that vote and try to water it down to make it look like nothing has changed. And I think that ultimately there probably will be a more aggressive type of negotiation. But so far, you're absolutely right. That is where we're going.
Yeah, it's unfortunate. I thought it would have occurred already, but, in the new normal that we have now, it seems the politicians, whether it's in your country in England or Spain, which we talked about on our last interview, your home country, or here in the United States, they just ignore what the people vote them in for. They don't do what they say they're going to do.
Absolutely.
Well, Daniel, your wealth of information. I've kept you for a little over an hour or so, but I enjoyed our discussion. We covered a lot of great topics. If our listeners want to follow more of your work, they want to check out your books, how do they do so?
You can check all my articles and videos in my website. It's DLaCalle.com, DLACALLE.com. And you can follow me on Twitter at DLaCalle, DLACALLE_IA. So let's keep the dialogue.
And I'll also put a link to all your articles that you write for the Mises Institute.
Absolutely. All of them are there. Mm-hmm.
Okay, great. Well, thanks again for your time, and I look forward to speaking again in the near future.
Thank you so much. Always a pleasure, and say likewise. Have a good day.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.